JPL raises rates another 25 basis points even though we've got more banks failing. Welcome back to Click Capital, everyone, your go-to show for all the latest daily fundamental and technical analysis. My name's Jared and I'm going to take you through all the most important data, events and charts today. So stay with me right through to the end and I'll let you know how I'm personally positioned going forward. And to my regular viewers, apologies I didn't make it the last 2 days. I wasn't able to get into the office, but I'm back in the saddle now and ready to go, and what an interesting day I've got for you here. And just days after First Republic has been gobbled up by JP Morgan, we've got another California bank in trouble. With news just coming out as I speak that PacWest is looking for a buyer, so it looks like they're in trouble now. I'm just looking at a 5-minute chart in the after hours now, and they're down 53%, $3 a share. So it looks like this could be going the same way as First Republic, which is now traded on the over-the-counter exchange and currently valued at 39 cents a share. This stock was trading in the 140s just a little over 2 months ago. And with the Fed hiking rates again today, markets came off pretty red across the board, and we're selling off after hours on that PacWest news as well. So it looks like the banking crisis is ramping back up. They're finding it hard to keep isolated, and the market's starting to worry about it again. And just looking at the heat map today, we can see it was mostly red across the board. Energy continues to sell off with the oil price coming down. Financials got hit hard today and are getting hit hard after hours. Megacap tech was mostly mixed, and the defensive sectors, consumer, utilities and healthcare holding up a little bit today. And over to economic data today, we saw that ADP employment change come in about double more than expected, so the jobs market is still healthy. And global PMIs came in a bit weaker than expected, but still in expansive mode above 50 here. Same with ISM non-manufacturing employment and PMI as well. Tomorrow we've got jobless claims, and then the big one, non-farm payrolls on Friday we'll be looking at. And just a quick bird's eye view of some economic data for you here. In this column is the last reading we've got for each indicator, and there's the previous reading. We can see GDP growth rate has come down from the previous reading. Unemployment's still low at 3.5%. Non-farm payrolls have come down. Inflation's coming down a little bit, but now we have a higher interest rate. And manufacturing PMIs are near contracting territory, but we still have strong services PMI, and retail sales are contracting as well. Fear and greed index right in the middle here, neutral territory at 52. Dark pool buyers showed a little interest to start off the week, but pulled back a little bit here today. And corporate insiders are becoming active again today, both with purchases and sales, but we do have sales outnumbering purchases yesterday, 152 to 119. Options market wasn't too busy today, with 35 million contracts changing hands and equal amount of puts and calls. Interesting to note, 71% of trades in the Russell 2000 were puts and 92% in high yield bonds were puts as well. And now the Fed just hiked today as we forecast. We're now got a 17% chance we're going to get another hike in June. And even though the Fed probably is nearing the end of its hiking cycle, and Jay did come in with a little bit more dovish commentary today and saying that the door's still open on the June decision. They're really going to have to look at the data. He did reiterate that they don't have any plans to cut rates as inflation is well above their target of 2%. So the plan is to probably go on hold now. Maybe we get one more hike if this banking crisis settles down and inflation data comes in hot. However, with this banking crisis reigniting, it looks like we could be done here. And the Fed fund futures market's actually pricing in a 39% chance that they're going to cut come July, and a 26% chance they're going to cut again in September. And the market has the target rate around 4.5% come end of year. So we're now back above 5% for the first time since 2007 in what's been the fastest Fed steepening ever. So we're probably close to being done here. And it looks like the legendary corporate raider himself, Carl Icahn, is getting a taste of his own medicine. And his listed company, Icahn Enterprises, is plunging after a report from Hindenburg Research said he's operating a Ponzi-like economic structure. And Hindenburg Research is probably the most powerful short-selling firm on the planet right now. They really have a big impact on stocks when they come out with their reports. And they've claimed Icahn's holding company used inflated asset valuations, further alleging Ponzi-like economic structures at the firm. They also said Icahn's been taking money from new investors to pay out dividends to old investors. And most of Icahn's wealth is in Icahn Enterprises stock with an 89% stake, so this affects him massively. And they responded the same day saying Hindenburg's research report is self-serving and intended to solely generate profits on Hindenburg's short position at the expense of IEP's long-term unit holders. And I'll show you this one on the charts soon as well. Okay, that's it for data today. Let's head on back over to the charts. So once again, the SP 500 has stalled out at this major resistance zone we've been watching for a few weeks here, and we're losing ground after hours as well. On news that PacWest is probably going to be the third California bank to go under. But stay with me and I'll come back to the main indices at the end of this video and I'll let you know how I'm positioned. Let's just go have a quick look at all the other major market categories first. With international stock indices, we've still got most above their 50-day with the TSX, the FTSE below it, the DAX still hovering near all-time highs, the Nikkei having a little pullback, the Aussie 200 coming back down to test, and China just slightly below as well. And as we've been forecasting, it looks like volatility has bottomed. We do have the VIX 9-day slightly above the VIX 30-day here, and signs that the market may be getting worried with what's happening in the banking sector. And considering it looks to have reignited, it's hard to see the VIX going back below 16 again. And we are due for a bit of a spike up again, so this PacWest thing tomorrow may get the VIX back over 20 and we could potentially spike up into the mid-20s later on this week or next week. And if that does happen, then the Fed will probably be done with interest rate hikes, and it'll be interesting to see how the market responds once the Fed communicates that. Volatility risk premium is creeping back up a little bit here too, and we've got the MOVE index holding steady at 134, and a few more puts being bought with a put call ratio at 101. Breadth continues to break down more than the main index prices, with the amount of stocks above the 20-day average at 35%, and we're at 45% for stocks above their long-term 200-day average. And we've still got growth versus defensive sectors trading under their 50, same with high beta stocks versus low volatility stocks. However, growth versus value seems to be holding up a little bit here, but I can imagine tomorrow that's going to come down somewhat, along with the tech versus SP spread as well. Copper versus gold continues to break down, and this is kind of a look at a growth commodity versus a defensive safe commodity, and can be used to measure risk sentiment and upcoming economic growth. So that continues to break down and trade weak. Same with commodities versus stocks. We're really low and oversold down here. However, gold is the standout commodity versus stocks and continues to show a little bit of a strength here above its 50. And the market continues to pull forward projections of recession, with the yield curves climbing back up towards a neutral zone, and we can see that with the 30-year versus the 2-year as well. Climbed a bit here today, almost back up to that neutral zone. High yield bonds versus treasuries have lost their 50, and inflation expectations to continue to come down a little bit here as well. And even though the Fed hiked rates today and said they don't plan to cut rates anytime soon, we did see the 2-year fall to 380, same with the 10-year as well. However, I think that's more to do with what's going on in the banking sector, as we've seen a lot of correlation between government bond yields and the banking sector price action ever since Silicon Valley Bank went under back here on the 10th of March. And we can see that in Fed fund futures, which hasn't sold off as much as government bond yields, so they're still above 5% for June. But the September's come off a little bit here at 495, and December's actually come down a bit as well. So basically the market's saying there's a little bit of chance we get one more hike next month. But the way it looks now with the banking crisis, I think we may not, they may be done. And the market's starting to price again more cuts come the end of the year. And if that were the case, the Treasury TLT may be looking good here, just reclaiming its 50-day here. And if we do see the 10-year bond lose that big 340 support level, we could see TLT break out here. And just looking at a monthly chart of TLT, we can see for over half a year it's been trying to form a rounded bottom here. So if we have seen at the top of the hiking cycle, we could easily see TLT break out from this big 110 resistance zone over the upcoming weeks. High yield bonds look to reject it off a resistance zone and maybe losing their 50 as well. And with those government bond yields coming down, the dollar got weaker as well, but still holding on this big 101 support zone that we've been watching. Bitcoin holding up as well with the banking crisis, and has done well ever since Silicon Valley Bank went under. So with PacWest looking to go under as well, this could see Bitcoin break out above 30,000 a coin over the upcoming days. And commodities continue their pullback and look to be testing lows we made back in mid-March on fears of weaker economic growth ahead. However, gold is the exception. Like Bitcoin, it's done really well ever since Silicon Valley Bank went under, and we're now back again close to testing new all-time highs above 2,000 an ounce here. And crude has surprisingly been sold off really hard this last couple of days. We're now just above $68 a barrel and coming up to this low from mid-March as well. And just a quick look at a 3-month chart of crude. We're now at the same price we were back at mid-2006. And I continue to remain bullish on the sector, as the best valuations to be found out there are in the energy stock sector. Agricultural commodities found support today on volume at their 50. And over to stock sectors, mostly red out there today, with a few exceptions. We did see semis come off 1% today. Biotech was up a huge 4.3% on the back of that big move up in Eli Lilly. Energy and oil and gas stocks down with the price of crude. Gold miners holding up with the price of gold. You can see we're up pretty big here after hours. And the financial sector, XLF, looks to have just lost its 50 and down after hours. And the regionals continue to get smashed. We're down 5.7% on the regional banking ETF as I speak. Transports continue to hold up above their 50. Believe it or not, home builders are close to breaking out to new year-to-date highs. Aerospace and defense stocks continue a pullback, and defensive sectors, healthcare, staples, and utilities continue their consolidation here as well. BlackRock continues to trade weak ever since we got news that CEO Larry Fink sold $25 million worth of stock back here. We've now lost to 50 and coming up to test new year-to-date lows. JP Morgan looks to reverse course after having really good earnings and news that it gobbled up First Republic Bank. Shares of Tesla calling up again here today, and we've got a big massive bearish divergence on our hidden divergence indicator, and I continue to think that we lose this Q4 earnings gap and fill it down to mid 140s. And Nvidia pulled back a little bit here today after we had that big move up on Monday, which caused a lot of shorts to capitulate, and I can imagine the topping process in this is going to be long and messy, as there is a lot of people short the stock, so the market will naturally try and shake those shorts out. But we continue to remain short the stock. And mega cap tech continuing to stall out here as well. We got the big one, Apple, reporting earnings tomorrow, and we're actually down here 2% after hours as I speak. Microsoft stalling out in a big resistance zone as well. Amazon rejected off its, and Google as well consolidating in resistance. And in another sign that semis continue to go into oversupply, we had AMD coming out today. Even though they beat on expectations, they did give weaker guidance, and we were down almost 10% today. So that's a negative for the semi sector and the market as a whole, as it's been the semi sector that's helped pull this market high this year. Netflix has lost its 50 and is trading weak as well. And Bed Bath & Beyond is officially going bankrupt and closing down all 500 of their stores. And typically what happens when you see stocks announce bankruptcy, they will be delisted off the main exchange like the NYSE NASDAQ, and they'll be moved to the over-the-counter exchange, and they get the letter Q, which denotes a bankruptcy. And this is just another sign of another long-term retailer succumbing to the secular trend of the move from physical to online. And Coinbase down 5% here today and continues to trade weak, and I think this could get a lot weaker as the US government is basically trying to shut down crypto in America, and these guys already charge really high fees. So even though they'll try to move offshore, I can imagine their equity will suffer a lot from that, and I could see this stock really getting hit hard over the upcoming months. And we've got this on our short watch list and waiting for a bit of a pullback, possibly get short this stock. Other popular meme stocks like C3AI continue to trade weak, along with Snap, Beyond Meat, and Peloton as well. Eli Lilly was up big today, 6% on news that one of their drugs showed good data and results. And Starbucks got smashed 9% today after trading really well the last couple of months. They did report earnings today, and even though they beat a little bit, they did give weaker guidance, which the market didn't like. Estee Lauder got smashed 17% today after missing on earnings. And First Republic's been moved to the over-the-counter exchange as well and had a B added to its code, which means it's now the secondary class of shares. And here's the daily chart of Carl Icahn's company, Icahn Enterprises. And we saw after the Hindenburg research report come out, shares fell 20% and they fell another 20% today. So I can imagine Carl Icahn is absolutely livid at Hindenburg research, and he's quite a strongly outspoken guy. So we'll be following this story on the channel and it will be very interesting to watch unfold. And I can imagine Bill Ackman, a long-term nemesis of Carl Icahn, is enjoying watching this as well. Deutsche Bank still holding above its 50 here, and let's have a latest look at PacWest, down 58% now. Looks like we lost $3. So after Silicon Valley Bank and First Republic, this looks like the third large California bank about to go under as well. And just as I speak, I'm seeing Western Alliance down 30% after hours as well. So we're definitely going to get a spike up in volatility tomorrow, as it looks like the banking crisis had been contained. However, it looks to have just reignited now. So this should have big effects across markets tomorrow. Zion's Bank as well, down 11% after hours. And the big guys, Bank of America, Citigroup, and Wells as well getting a hit a little bit here. Same with Schwab, which just found new lows today as well, down 2.5% after hours. So it's going to be pretty messy out there tomorrow. All right, let's go back to the main indices for our final outlook. So just looking at the global net liquidity model, we can see we're a little bit over 200-point gap here. Did bounce up a little bit in the last couple of days, and we can see the main indices like SPY stalling out here, still on a bearish divergence, and the equal weight SP 500 as well on a big bearish divergence, close to losing its 50. And the Qs with mega cap tech stalling out, and the NASDAQ equal weight's actually below its 50. The Dow's kind of consolidating here as well. And the smaller we get, the weaker we get, with mid caps down here. Small caps still trending down. And micro caps yesterday actually broke down to new lows in this entire bear market that we've been having. And with all that, I continue with my bearish thesis that I've had the last couple of weeks and continue to remain 60% net short here. And still looking for that big correction and sell-off to really close this gap with the Fed liquidity model. And with the Fed just raising rates at unfortunate timing that the banking crisis looks to be reigniting, I can see the market has a good reason now to have a decent pullback, and the VIX over 20, which I expect to see tomorrow now. Alright guys, thanks for coming back and tuning in. I hope you enjoyed this video, and if you haven't already, hit that subscribe button and I'll keep you updated every day after market close with what's happening. Tomorrow's going to be an interesting one, so we'll see you then. Cheers.